I am looking at closing in on a short-term rental, and I am really excited about it. I'm actually going in with 0% down, and I wanted to compare these two options. They did offer like an ARM, an adjustable rate mortgage,
Mhm.
and I'm a little bit unfamiliar. So I wanted to know your thoughts on what are some questions I should ask. As far as, I don't mind, maybe a higher interest rate at the beginning. I don't mind that at all, because eventually I do want to have this as a source of revenue. And, over the next couple of months to a year, I'll be acquiring revenue and then putting that back into the loan. So, what are your thoughts on comparing the adjustable rate mortgage as opposed to the traditional?
Valerie, how are you this morning? That is a great question. So let me ask you a couple of questions about that. Are they offering you a lower interest rate to take the adjustable rate loan?
If I remember correctly, it was a higher rate for the adjustable rate.
Really?
Yes.
Okay, usually it's the other way around.
I think
But
so.
what we're looking at is a couple of things. When you are engaging in the pill method and using your resources not to cut interest cost and to build equity 5 times faster, let's just say you have an adjustable rate and it's going to adjust after what? Is it supposed to adjust? Is it a 5-1 or 7-1? Did they say if it's going to adjust after 5 years or 7 years?
They,
Did you have that information?
they offered both 5 and 7.
5 and 7. Okay, let's just pick the 7. All right. Let's say it's going to adjust after 7 years. And can you give us an idea of how much the loan would be at the outset?
The principal offer was for 200K and the
200K.
interest.
Yeah,
Mhm,
yeah. I just need something to work with. Okay.
mhm.
Yeah, even if it's just made up, we're working with 200K. All right. And the interest rate is floating around what?
4.75.
4.75. All right. And a 30 year?
Yes.
Great. All right. So now the payment on that is $1,043.29 in 7 years. Okay. All right. That's 84 payments. All right. In 7 years, you would have paid this loan down. If you just made the minimum payment, you paid it down by $25,000 and it would cost 62 grand in interest to do that. And now we have to take a look at what if the rate adjusts up, okay? Or it
Okay.
could adjust down. So now here's what most people are afraid of. If it adjusts up, then it's going to cause me a problem. But know this, you've already paid the loan down by $25,000. Now it's going to adjust on a loan of $174,000. So it would have to adjust up quite a bit to be a problem for you. But what if at the end of the 7 years, you didn't pay the loan down by $25,000? What if you had paid the loan down by $75,000 or $100,000 in that 7 years?
Right.
Okay. So now let's go down to 100,000. That's just like paying off 20 years on this loan. And so you only have $99,000 left at the 7 year mark, right? And if
Yeah.
it adjusts up, it only adjusts on the $99,000. Even if it adjusts up quite a bit, your payment would still be lower then than it is now.
Right.
Okay. And there is no rule of thumb that I can give you. There is none. All I can give you is what are the things that we need to take a look at in terms of what our options would be. What are all the different parameters we would need to take a look at, whether it's going to adjust up, how fast can we pay the loan down, how cheaply can we pay the loan down, and then what we don't want to do is play the game of, do I want the adjustable rate loan or do I want the fixed rate loan? And I'm comparing two 30-year loans. Because if you wanted to work with us, we could plug these numbers in for you and say, based on what you have here, you could be at this point in this loan in 7 years. And we could predict that for you. Now you have a new set of parameters. You're not comparing two 30-year loans. You're comparing the bank's 30-year loan against your 7-year loan or your 9-year loan. And then take a look at what we could do there and see how the two interest rates might help you or hurt you. The bottom line is, Valerie, how much is it going to cost you to manage these loans overall? Don't just look at the interest rate, but let's see how we can manage the interest cost. And we can help you to predict that using financial technology that you can put the numbers in and see your results years in advance. And you know what they say, people lie, but numbers don't lie.
Yes. Thank you so much. I appreciate it.
You're welcome so much.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L.L method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.